Well, hello and welcome to another spectacular screencast from yours truly, Seth David of Nerd Enterprises Incorporated. Now over at new.nerdenterprises.com. Check us out. Join the new website. Join Nerd Buzz. That's where you get the more detailed write-ups and exercise files when there are some. Downloads, those kind of things. All there. It's all free, but you do have to sign up with your email address in order to get the access. So, today we're talking about a QuickBooks Online tutorial. What happens when the customer pays less? And that, of course, begs the question, well, why did the customer pay less? If the customer simply, paid less than the full balance and they owe you the balance, and there's nothing spectacular about that, I wouldn't be doing this video and blog post. I'm talking about unusual situations where, let's say the customer had loaned you money and they're just deducting what they loaned you from their payment. Or, as was the case when the inquiry actually came into my inbox a little while ago, the person wrote in, they said they had a situation where their customer actually got paid a commission on the services that they were providing to that customer. So the customer simply deducted their commission out of what they owed them. So that gets a little tricky, no? I'm going to show you how to look at this whole thing and how to book the how to do the accounting in both scenarios. And in the case of the commission, we're going to show you. I'm going to sort of half demonstrate one way, and then I'm going to show you the way I would have you do it. The difference being the compliance method versus the bulletproof method. The bulletproof method, as I mentioned in the write-up, well, it's cleaner, and it usually also requires a little bit more work. That's usually how that works. That's what makes it bulletproof. We have a nice, clean audit trail, and that has a lot to do with how we record the transactions. So let's take a look at my books, and let me show you what we've got going on. So we have an invoice that's being paid. Let's go quickly run a receivables report. Open invoices. So Always Right is going to come in, and they're going to pay us, but they're only going to pay us $7,500, right? Because they're holding back $2,500 because either we owe them a commission of 25% of the $10,000, or because they loaned us $2,500 and they're going to just hold that back to pay themselves back in effect. So let's deal with the first part, which is going to be the same no matter what, which is either way, we have to give the customer credit for having paid this invoice in full, even though that isn't what we got in the form of a payment from them. Even though we didn't get the full payment, we still have to record it as though we did, and then we deal with the deduction separately. So we're going to go into Always Right, and this receive payment screen really would be more accurately titled, Give the customer credit for having paid their invoice, right? Because again, we didn't get the full amount of the $10,000, but we have to pretend like we did. So amount received, $10,000. Now one of the tricks here is this needs to go into undeposited funds. The infamous undeposited funds. And the reason why is because we need to put that extra step in the mix before the money goes into the account, so that we'll have the opportunity to deal with the next piece, which is either to pay off the loan or to account for the commission that our customer is effectively receiving by deducting a portion of this payment, right? So let's say the payment's happening today on August 31st. And we'll save and close. Okay? Let's look at a balance sheet. I like to look at balance sheets and profit and losses while I'm doing this stuff. So accounts receivable has been zeroed out. It's effectively moved over to undeposited funds, right? So I also went ahead of time and prepared for the situation where we're paying off a loan payable. So let's look at that scenario first, and also because it's much easier. So loan payable, all I have to do now is go to record the deposit, and I'm going to pick off the full $10,000 payment, and we're going to reduce it by $2,500. That's the easy part. We'll take care of the easy part first. So now we have the right net amount of $7,500 that we actually did get in the bank, and let's put this in we'll put this in the iBank account. And the account here to pay off the loan is going to be very simply loan payable, right? Now, if I record this, we will see that the balance sheet is perfect now. iBank now has the $7,500 in it. This checking has the $2,500 that was originally loaned us, but now that loan has been satisfied. It's been paid off in lieu of the partial payment on our accounts receivable. So that's how you would do it for the loan, right? I don't even imagine there'd be another way I would want to do it for the situation where it was a loan. But now let's back up. let's get rid of this deposit, and let's look at the commission payment scenario. Now, actually, let me stop here because there's two commission payment scenarios. I mentioned this. There's sort of the compliance way of doing it and the bulletproof way of doing it. The compliance way would simply be to you do it the same way as you do with the loan, only here the account would be some kind of commissions expense account, right? And we can even put in a description and say customer deducted their commission on their own sale, which is essentially what's happening here. And you could absolutely do that, and that would work. The books would be right. If I save and close, the balance sheet really doesn't change here, except now I still have the loan payable because I didn't pay it off with that. And now if I run the profit and loss, you'll see that we'll have our commissions expense properly reported. And there it is, commissions expense. We have our income from the invoice of $10,000. We paid out the commission by just not getting paid the full amount, and so we're left with the $7,500. That's correct. That's right. But it's not what I would call bulletproof. I would call it compliance. It's just not as clean an audit trail as the other way I want to show you. So let's click in here, and you're actually seeing the evidence of why I think it's not as clean, because I'm clicking into an expense, and it's taking me into a deposit essentially. And that's where it's just not that it's wrong, but it just gets a little weird when you have a deposit driving an expense account. Again, it's not wrong. It's just not what I would call bulletproof. Here's what I would call bulletproof. We're going to do this a little differently. So the first thing I'm going to do is we're going to hold this aside for a minute, actually. Let me duplicate the tab. A bulletproof set of books having a really clean audit trail means that, in simple terms, anything that's in the expense section of the P&L is driven by an expense type of transaction, like a bill or a check or a credit card charge, anything like that, right? So in this case, what we're going to do is we're going to create a bill for the commission. Okay, so I'm going to enter a bill, and I'm going to do it based on the date I received the payment, which we said was August 31st, so that's fine. The bill is actually going to go right back to Always Right, but we'll need a vendor version of them. And we should have a vendor version of them, because if we're paying them commissions, then they serve two roles with us. One is as customer who's purchasing our services. The other is as a vendor who's receiving commissions from us, which means we're in effect paying them for probably because they referred us this business or whatever it was. So we're giving them kind of a referral back for giving us their own business, and maybe we're giving them commissions on anybody else they referred us. I have just that kind of a relationship with one company where I signed up with them. I signed up to become an affiliate, and I get commissions back every month on the on my bill that I pay them each month. So similar idea. Here we're going to have commissions expense. Okay, and what I would do here is, let's go back to the invoice. Where am I? We're going to get out of here for a second. I want to go back to my P&L. What I would probably be inclined to do is reference this invoice in the bill. Okay, so the invoice number is here. I don't even know where that number came from. That's funny. I guess, well, obviously it's an auto numbering thing. Anyway, so I would say see invoice number that. Customer would be Always Right. Okay, we're not going to use class on this. And this is going to create a super clean audit trail. I've referenced the invoice. Heck, it's QBO. I can even take the URL for the invoice itself and paste it right here in the bill. How's that for awesome? All right, and then I'll hit save and close. Okay, and then what we're going to do is go back to the deposit. Okay, let's see if I can grab it from the recent transactions here. Okay, and so instead of doing it this way, right now if I look at a P&L, it's going to be doubled, once here and once for the bill I just entered, right? Let me prove it. Okay, see the commissions are $5,000. So what we're going to do here is instead we're going to book this to accounts payable. When we do that, we'll need the vendor in the receive from. Save and close. and then we're going to go pretend like we're paying that vendor, right? So we're going to go pay bills. I check off always right, but it found the credit and applied it for me. It was pretty straightforward. So there's no actual payment to record here. I'll hit save and close. Now our P&L is right, but when I click into the commission expense, it's driven by a bill. And when I click into the bill, I can see very clearly that it was related to this invoice. I can go into that URL by copying and pasting it. And boom. And here I could even add in a memo that says subject to commissions payable on this bill, right? So like I said, it's a bit of extra work, but it keeps the audit trail squeaky clean. I can guarantee you, if you record your transactions this way in this kind of detail and you're ever audited, that audit will be quick and painless, right? Because you're giving the auditor, and it may not be an auditor, it may just be some stakeholder, it may be a bank who's interested in lending the company money, and they're going through your books and scrutinizing things to make sure that they're satisfied that A, the balance sheet they're looking at is accurate, because a potential lender wants to feel assured that you're going to be able to pay them back. That's what their whole due diligence process is all about, is determining the likelihood that you're going to be able to pay them back, and if that likelihood isn't extremely high, they're not going to lend you the money. So the easier you can make it for somebody in that kind of a position, the easier you make it for yourself in the long run. That's the difference between Bulletproof and compliance. It's not just about keeping copies of records. It's about the audit trail that you create in the way that you record your transactions. And that's why I wanted to give you the two examples and show you and explain to you why what I call the Bulletproof method, in my opinion, is much cleaner. If you have any questions, post them in the comments below. If you're watching this on YouTube, check the description for a link over to NerdBuzz. You do have to sign up to get an account on NerdBuzz. It's free, but you'll be able to access this, the full write-up, and get the whole experience. And I don't think there's going to be one for this one, but in general, when there are exercise files to download, that is where you'll be able to access and download those exercise files. That, my friends, is all I have for you on what to do when the customer pays less.